On February 2, 2025, the U.S. administration made a move that sent shockwaves through the North American energy market. They imposed tariffs on Canadian energy imports. This decision marked a significant escalation in trade tensions between the two traditionally close allies. The tariffs targeted a range of energy products, excluding crude oil, natural gas, and other key energy commodities. A 10% tariff was levied on these Canadian imports. The immediate impact was a surge in oil prices. Brent crude, a global benchmark, jumped 5%, reaching $95 per barrel. West Texas Intermediate, the U.S. benchmark, also saw a significant increase, hitting $90 per barrel. This price spike reflected the market's uncertainty and concern over the future of U.S.-Canada energy trade. The tariffs signaled a potential disruption in the flow of energy products between the two countries. This decision to impose tariffs came as a surprise to many. It marked a departure from the previous year's focus on promoting clean energy and strengthening alliances. The move was met with immediate criticism from industry experts and warnings of potential economic consequences. The tariffs had the potential to disrupt deeply integrated energy markets and supply chains. Canada wasted no time in responding to the U.S. tariffs. Prime Minister Justin Trudeau denounced the tariffs as unjustified and harmful. He announced retaliatory tariffs on a range of U.S. imports. These retaliatory tariffs were carefully calibrated to target key U.S. industries. The first wave, effective February 4, 2025, imposed a 25% tariff on $30 billion Canadian dollars worth of U.S. imports. A second wave, scheduled for February 25, 2025, threatened an additional 25% tariff on $125 billion Canadian dollars worth of U.S. goods. This tit-for-tat response underscored the seriousness with which Canada viewed the U.S. actions. The Canadian government made it clear that they were prepared to defend their interests in the face of what they perceived as unfair trade practices. The U.S. tariffs also drew reactions from other major players in the global economy. Mexico and China, both significant trading partners of the U.S., expressed concern over the escalating trade tensions. Mexico's president, Claudia Sheinbaum, criticized the tariffs. She initiated Plan B countermeasures, indicating a willingness to protect Mexican economic interests. China, already engaged in a trade war with the U.S., found itself further drawn into the fray. The U.S. tariffs on Canadian and Mexican goods came alongside additional tariffs targeted at Chinese products. This escalation of trade disputes created a climate of uncertainty and raised concerns about the future of global trade relations. The tariffs imposed by the U.S. sent shockwaves through the North American energy market, disrupting the deeply integrated energy trade between the three countries. Canada, a major energy exporter, was particularly vulnerable to these disruptions. The country exports over 4 million barrels per day of crude oil to the U.S., relying heavily on U.S. pipelines for transportation. U.S. refineries, particularly those in the Midwest, depend heavily on Canadian crude. These refineries are optimized for the heavier grades of oil that Canada supplies. Finding alternative sources for this crude, such as domestic light, sweet crude, proved to be a challenge. The tariffs threatened to disrupt this delicate balance, potentially leading to supply shortages and price increases. The tariffs' impact went beyond crude oil, affecting various sectors of the North American energy market. Regional natural gas price spreads were expected to widen, creating price disparities across different regions. The trade of polyethylene and polypropylene, essential components in various industries, was also disrupted. Furthermore, the tariffs threatened to add billions of dollars in costs to North American steel trading, potentially impacting industries reliant on steel. The agricultural sector was not spared either, with U.S. corn and soybean sales to China and Mexico facing potential disruptions. The tariffs had far-reaching consequences, affecting the livelihoods of millions of people across North America. Please like and subscribe to our channel for more updates on the U.S.-Canada energy trade war and other global energy news. The U.S.-Canada energy trade war sent ripples across the global energy landscape, accelerating existing trends and creating new geopolitical realities. One of the most significant impacts was the acceleration of the shift towards electric vehicles. As oil prices surged in response to the tariffs, consumers and governments alike looked for alternatives to traditional fossil fuels. The U.S. government, recognizing this shift, announced a $10 billion investment in EV infrastructure to support the transition to cleaner transportation. This move signaled a potential turning point in the global energy market. with EVs poised to play an increasingly important role. The tariffs also had profound geopolitical ramifications. The US, by imposing tariffs on its allies, risked damaging its credibility as a reliable energy trading partner. This created an opportunity for other global players, such as China, to step in and strengthen their ties with energy-rich nations. Latin American countries, traditionally reliant on the US as a major energy trading partner, began exploring alternative partnerships. China, with its growing economic clout and thirst for resources, was well positioned to capitalize on this shift. The tariffs, intended to strengthen US energy dominance, ironically had the potential to undermine it in the long run.